Welcome everyone, excited to be with you today for our workshop to talk about what to do after maximizing your 401k or retirement plans as a court reporter. We're going to talk about different options that you can look at and how maybe we can get some more tax benefits after the tax benefits that you're already getting from those retirement accounts. As we know, as court reporters, we want to save as much on taxes as we can and be as strategic as we can with the money that we're earning. So let's dive in and get started. All right. First and foremost, you're already doing a great job here. If you're on this call today and you're already maxing out your retirement accounts, that's giving you a great start for your financial plan. I often have clients that really, we'll ask all these questions about the rates of return that we're getting and what we can do in their portfolio. And of course, those things are all very important. But a lot of times, if we just saved a little bit more money toward the retirement plan, the compounding growth on those accounts is going to exponentially outweigh the difference of a 0.5% or a 1% difference in rate of return. So we want to make sure that we're getting as much money into these retirement accounts and letting them grow and getting started sooner rather than later so that they have that time to build up and grow. So if you're already maxing these accounts out, you're doing a great job. I think there's two situations here. Number one is you could be maxing out your account and you already have the best plan available as far as the most contributions, which would be the solo 401k. So you could be maxing that out and want to know what to do next. The other situation that I run into is sometimes people pick a plan. Let's say they want to do a SEP IRA for this year. And the SEP IRA limit for them specifically is only $15,000. Maybe they max out that $15,000 and they wish they did a different plan where they could save even more to their retirement. But unfortunately, once you contribute to one plan, you can't switch throughout the year. You're locked in for the year until January, and then you can start a new plan. So what are maybe some other options to finish out this year before you switch into a new plan for next year? So some people could be in that bucket as well. So as far as what we see with court reporters is you could be earning anywhere from $60,000, depending on where you live, all the way up to over $300,000 of income. And so for those who are on that higher income threshold, there's a lot of great options as a business owner contribute to retirement, but there's still the potential to max out and want to save more on top of that. Also, we see that court reporters have a lot of fluctuating income and cash flow. So how can we factor that fluctuating income into the planning and giving you flexibility with your investment strategies as well? And then lastly, is just a lot of wealth building opportunity. Some of our court reporters that we work with are earning $10,000 to $15,000 a month. They don't need anything near that to live their life. So they have a huge surplus that often we see is just going into their business account or their personal account. And they've just been building cash because they're not sure exactly what to do with that money yet. So we want to make sure we have a good game plan and you take advantage of these hard-earned dollars and get them into accounts that are going to, number one, grow for you, but also be as tax efficient as possible as well. So we're going to talk about 5 different options you can pick from if you either are maxing out your 401k or don't have the ability to do anything more into whatever retirement plan you set up. So strategy number 1 is going to look at opening up a brokerage account. Now, a brokerage account, think of it as the wrapper on the outside of the account is how these are differentiated. So for example, the difference between a brokerage account I'm showing you here and a solo 401k or a SEP IRA is not the actual investments that we hold in the portfolio. It's just the wrapper outside of it. So what are the tax rules that are associated with these accounts? So for a brokerage account, one of the key benefits here is that there's no contribution limits. It's just an investment account that you can add as much money as you want into. So that's the nice benefit is there's no maximum contribution. The downside is that they are one of the least tax efficient accounts. And the reason being is because the money you put into the account, you've already paid taxes on. Then as it grows, if any of these companies pay you dividends or profits, you have to pay taxes while the accounts are still growing. And then when you go to liquidate the account, if the stock price or the investment went up in value, and then you go and sell after that point, then that difference of the starting price versus the price today, you're going to have to pay tax on that as well. So it's after tax money that is taxed as it grows and taxes as you take it out. The only ways that we can get some tax efficient growth in these is that some investment strategies, such as buying certain stocks, they are known to not pay dividends. So you're not taxed as it grows. And then we can just let that money sit and grow for a long period of time without paying taxes as it's growing. So then you're only paying taxes at the end. So that is one benefit that you can get with this account. But mainly the biggest perk is that it's your best investment strategy that has no limit, and you can just add as much money as you want to it. So strategy number 2 is going to be a health savings account. And for a health savings account, the nice part about this account is that is the only place in the tax code that you could have triple tax-free savings. And so what I mean by that is you can put money into this plan and get a tax deduction for this year. So lower your income by whatever you contribute into the plan. Then once you have over $1,000 in your HSA account, you're allowed to start investing it. So you can invest that money and that investment gets to grow completely tax-free. And then when you go to take the money out, if you use that money for any type of medical expense, you get to take that money out tax-free as well. So no taxes on the money you put in, no taxes on the growth, and you get to take the money out completely tax-free to spend as well. So triple tax-free savings, and that's the only place that you can do that. So it's a great account. The other nice part about the HSA is once you reach age 60, you can take the money out from this account for whatever you want. So you can use it for retirement, just like your SEP IRA or solo 401k. So some people, even though they know they don't have high medical expenses right now, and they don't want to be contributing all this money for medical costs specifically, they're instead almost using this as like a pseudo retirement account. The limit here is $4,100 for individuals and $8,300 for families. And then there is an extra $1,000 catch-up contribution that you can do at age 55. So we can be putting all this money into this plan, another $8,000 a year for married couples, and then get to access that money in retirement and spend it just like your other retirement accounts. If you're not using it for medical expenses, though, and you are treating it as a retirement account, when you take money out in retirement, it will count as income, just like it would for any pre-tax retirement accounts. So again, you put the money in tax-free, it grows tax-free, but then every dollar you take out of the account is $1 of income for that year. So you got to keep that in mind. Option number 3 is real estate investments. So when we look at building a retirement plan for our clients, we look at number 1, how much guaranteed income are they going to be getting? And then number 2, what are they going to have from their investment accounts to pay for everything else in their discretionary spending? So one option that clients look at doing is they look at setting up rental properties or real estate investments that's going to be paying them an income in retirement. So that way they get Social Security and they could get rental income on top of that's guaranteed to be coming in every single month as part of their retirement plan, on top of the investments that they'll be able to withdraw from to use for their expenses. So it's just building more of a baseline income for you, or I would call it like mailbox money, right? What's the check that you're going to be getting every single month coming in the door for retirement? Now, obviously, if you own a rental property, you could have tenants not living there for 1 or 2 months while you're in between leases and things like that. So it's not perfectly guaranteed, but for the most part, you're going to have consistent income coming in. The other option is looking at either like REITs, real estate investment trusts, or other crowdfunding sources like Fundrise, where you get the opportunity to invest in real estate without being a landlord directly. So basically, they take all this money from everyone and they pull it together. And then there's managers that will go take that money and buy skyscrapers or commercial real estate buildings, and you get to benefit from the income that those real estate investments bring in. But you are basically using those managers as like your property manager. And obviously you're not paying for the whole property. You just have one small percentage of that property. So it allows you to invest at a smaller scale as well. So that's another option. Strategy number four, and this is something that's really big right now, is looking at Treasury bills or municipal bonds. The reason that these are popular right now is because interest rates are so high that you can get a good rate of return on these accounts without taking any risk, right? The government's never defaulted on a loan, not yet. So we can invest into these plans and get some of that tax-free growth. So we have two options here. We have Treasury bills and muni bonds, and they basically flip flop on their tax status. So a Treasury bill, you're buying from the government, and just think of wherever you buy it from, that's where you have to pay your taxes still. I know it sounds a little bit backwards, but that's how it is. So when you buy your Treasury bill from the federal government, that means that you will owe federal income taxes on the gains that you have in that account. However, it is state income tax free. So for those of us living where I am here in California, it'd be a huge benefit to have not only getting a decent rate of return right now, but also being able to save on your taxes by having that California income tax free. Muni bonds, like I said, are the opposite. So these could be state issued or even like county or city issued bonds that you can invest in. And so again, because it's coming from the state, that means that we're benefiting on the federal side and that we have to pay our state income taxes. So you are buying a state municipal bond, you owe state income taxes, but now we don't have to pay federal income tax rates on any of the gains that we have in that portfolio. Strategy number five is looking at a backdoor Roth IRA. So for most of the reporters that we're working with, they're making too much money to be able to contribute directly to a Roth IRA on their own. So we have to look at doing a backdoor Roth IRA. If you think that you might be under the income limits for a Roth IRA, you can definitely look that up. That is another option that you can do, even if you're doing the plan through work. So you could be maxing out your SEP IRA and still be doing a Roth IRA as well. For those who are making too much, they can look at doing a backdoor Roth IRA. And what the backdoor part of it means is that it means that you basically put the money in the wrong account and then transfer it to the right account that you want, which is the Roth IRA. And this is a loophole in the tax code to be able to take advantage of those income limits. So this is an option to be able to add money into a Roth IRA, even if your income is too high. So essentially the way that we do that is you set up both an IRA and a Roth IRA, and then you're moving the money from the IRA that you contributed to after, and then you move it into the Roth. So this is something we could go over in more detail in a future webinar, but that is another option that you have available to get more money into this retirement plan. So once you know that you're maxing out your accounts, or even regardless, if you have this extra money after you've maxed out your 401k or your retirement plan, you want to think about what should I be doing? We have an order of operations here of what you should be thinking about. First and foremost, we need to have an emergency fund put in place regardless. So if you've been focusing on retirement and neglecting your emergency fund and you feel like you just don't need that much in cash, that would be step number one, would be to actually go back and focus on building an emergency fund. Somewhere around 6 to 12 months of expenses is a good threshold to think about. For court reporters, I would probably go on the higher side of that because it's so easy for you to be out of work. Disability insurance is insanely expensive. So odds are is we're going to need a lot more money for emergency funds than someone who's maybe a traditional W-2 employee, where it'd be much harder for them to be put out of work. Once you do have emergency fund in place, we can start looking at those retirement accounts. So go back to funding the retirement plan and see how you're doing there. And then if you are maxing out the retirement, we want to think about what's next. We can look at funding the HSA and maxing that account out, or contributing just to that in general. And then once we've done all of these three, then we can start to look at additional investments, such as some of those other things I mentioned, brokerage accounts, kids' education accounts, life insurance planning, right? There's a lot of different investment vehicles out there. Some of those may be a little bit higher ranked for you if your kids are getting close to school, or you have some other major goals that you're prioritizing outside of retirement. But assuming that you're at the stage where really retirement's the only thing you're focused on, I would say emergency funds, number one, retirement plans are number two, and then HSA would be number three. So outside of this, if you're feeling like, hey, I'm maxing out this retirement plan, I'm doing the HSA, or maybe you're just not eligible from the healthcare plan that you have, and what are some other ways that I can think about optimizing my taxes as a court reporter? Number one is in your investments. You can look at things like tax loss harvesting. Tax loss harvesting means that you sell your investments at a loss on purpose when they're down in order to have losses that you can use to offset gains in the future on your taxes. So you sell at a loss, you buy something different for 30 days, and then you can go buy back what you owned before and then invest and let it grow. So you're using losses to offset gains in the future, and you're selling at a loss on purpose. So that's one thing you can do to help save on taxes. Also, asset location. And what that means is where are you putting each type of account or each type of money that you have in your account or investment strategy. So if you have your stocks in an account like your brokerage account that's taxable, that stocks, they may not have any dividends. So you're not going to have to pay taxes from year to year. And then your bonds are going to be paying interest. And so you're going to have income from those bonds. So those bonds you may want to have in your IRA accounts that get to grow tax-free. So looking at putting bonds in retirement accounts and stocks and brokerage accounts, right, where you're differentiating your assets can help you lower your taxes from year to year. Of course, business expense deductions is important. Writing off your home office, your equipment, the conferences you attend can be great ways to lower your income as well and save on taxes. And then lastly, just seeking like a CPA or some type of accountant that can help review your taxes and see if there's any opportunities that you might be missing. Maybe you got really close to this tax threshold this year, and we want to figure out how you can avoid it for next year. That's not something that our firm does, but reaching out to a CPA or accountant can definitely help you with that. So some of the common mistakes to avoid, number one is now that you are making great money and you want to do something outside of your retirement plan, one thing you could end up doing is just not doing anything and then maybe starting to slowly accidentally adjust your lifestyle for this higher income. You know, you see your bank accounts continuing to go up, life's good, you're happy, and then we start going on vacations, spending more money. And the next thing we know, we're not taking advantage of these retirement accounts and we're falling behind. So we want to make sure that you don't continue to increase your lifestyle with your income increase. We want to always leave room for savings. Number two is tax surprises, right? We got to pay our quarterly taxes on time and stay on top of saving for taxes. I know for me personally, you make your money and you bring your money in and you're happy with the number. And then you go, oh, wait, I forgot that I need to set aside a huge chunk of this for my taxes that I'm going to owe. And it's not as much as I thought, right? So you got to make sure that we're setting money aside for taxes and we're staying on top of that. The last thing you want is this huge tax bomb coming in April. Also, chasing hot tips, I think with social media these days is especially prevalent. I feel like there's a new trending buzzword that comes up in my meetings every 6 months. It's a new word that's coming up. A while ago, it was I-bonds, and then it was Bitcoin, and then it's Treasury bills, right? There's always this new hot thing that we could look at investing our money in. And we want to stick to the tried and true investment strategies. Maybe there's something here and there that we can look at and do a lot of research on and invest in. But for the most part, these trends are something that we want to avoid. And then lastly, I mentioned it a little bit earlier, but liquidity shortage. So again, if we're doing a lot of money to our retirement plan because we want to max that out, but then we're not keeping enough money in cash set aside for emergency funds, this can be a whole other problem where if we're in an emergency, we don't have that much money to access, and we're going to have to turn to our retirement accounts. And anything you take out of your retirement account is going to be at a loss, right? So we don't want to have that loss that we're dealing with and have to pay a penalty and pay taxes on it, right? So it's just a slippery slope there, accessing our retirement accounts early. So we want to make sure we have enough of a backup plan where we wouldn't have to resort to that. So lastly here, if these situations apply to you and you're doing a great job with your retirement plans, but you want to see what else is out there or what you specifically should start to focus on next, feel free to reach out to me. I'll put in the comments a link to book time on my calendar, and we can get something set up to discuss this a bit further and look at your situation individually. I'm happy to do a free consultation and see how we can help and answer your questions. Outside of that, if you are viewing this outside of the Facebook group today, feel free to join our Facebook group, Court Reporters Financial Planning Forum. My goal is just to continue building the group and having a place where people can learn and benefit and secure their future, and have it being in the lens of a court reporter, so you know that it's going to be specific to your industry and all the different unique financial challenges that you face. So with that, let me know if you guys have any questions or anything in the comments, but I hope you have a great rest of your week, and I'll see you all again soon.